Yeah, so the topics I'm going to be going over here today is the investment accounts here in Canada, and that's going to be broken between three different avenues. It's the registered accounts, non-registered accounts, and then we're going to talk about some asset allocation, what to look for. So within the registered accounts, we're going to be looking at the registered retirement savings plan known as the RRSP, the tax-free savings account known as the TFSA, the first home savings account known as the FHSA, and the registered education saving plan, which Yannick will cover in his section. The next we're going to look at is non-registered accounts, what they are, how we can use them, and how they're a little bit more flexible, and the asset allocation. So again, we're going to look at the RRSP, the Registered Retirement Savings Plan. Now, this plan is very advantageous for people making income and looking to save for retirement, as it's called, a retirement savings plan. It's very tax advantaged because the contributions to your registered retirement savings plan are tax deductible. What that means is that if you're making $100,000 and you invest $8,000, then your taxable income is now $92,000. So you're saving money on tax. This will allow it to grow tax deferred until you withdraw it. And when you withdraw it, hopefully it'll be in retirement and you'll be at a lower income bracket, so your taxes will be a little bit lower. I'll have an example to show you how these work. Now, contribution limits with the registered retirement savings plan is 18% of your previous year's income. So if I made $100,000 in 2023, this year my contribution room, if I didn't have any to carry over, would be $18,000. Now, you can't have that unlimited. It's to a maximum of $31,560. In 2024 is the max you can make or put into your RRSP if you're a high income earner, and that's subject to change as well due to inflation. And last year it was 30,000, this year is 31,560. So it's going to continue to go up more inflation goes up. And then withdrawal rules. The withdrawals are taxed as regular income, but there are exceptions for a few vehicles, such as the first time home buyers plan and the lifelong learning plan. Withdrawals are taken as taxable because it is income used for retirement. So if you take it before retirement, you're going to be just adding to your income for that year. And here's some examples. So this next slide is, I think, very powerful, and we're going to go over it here. So this is assuming that you made $100,000. That's how much you took home, and you invested zero into your RRSP throughout the year. Your total net pay for that year after taxes, CPP, and EI is $73,271. And your average tax rate is 21.6, marginal tax rate 30.5, comprehensive deduction rate is 26.73. Now, thought process for people that have not built the habit yet of investing is that if you invest it, you lose that money. A key example to show you that investing your money actually gives you more money at the end of the year is actually the next slide. So if we look here, we made 100,000 and we're assuming that we made 100,000 last year. So our contribution availability was 18,000 for this year. This individual invested 18,000 in his RRSP, which then lowered his average tax rate from 21.62 to 16.13. And you notice that the total net pay, this is the most powerful part, is the 78,000 in comparison to 73,000. So he made about 5,500 more total pay by investing because of the tax return. So what that does is it allows you to have more net pay. The government's going to pay you back for investing in your future, and then you can use the extra 5,000 that you have now and reinvest that into different accounts that we're going to take a look at. Within the RRSP, there's the first time home buyers plan. And this is a vehicle that the government of Canada has made to allow home buyers to withdraw up to $60,000 from their RRSPs, their registered retirement savings plan. Now, in previous years, it was maximum $35,000, but as of 2024, they've increased that to $60,000. And it's to buy or build a qualifying home. So if you've had a principal residence or have previously owned a residence that you've lived in, it will not work. Withdrawal limit is up to $60,000 per individual. So if you think you and your partner have yet to purchase a home and you're investing quite heavily, you can have up to $120,000 of purchasing power for your first home through this plan. Eligibility, you must be first-time home buyer, must have a written agreement to buy or build your qualifying home, and you must buy or build within the 1 year, move into your principal residence within the 1 year of the withdrawing the 60,000 or however much that you're withdrawing, because it doesn't need to be just 60,000. If you only have 20,000, let's say in your RSPs, and you want to use them, you can use the 20,000. Now the repayment terms. Withdrawn amount must be repaid to the RRSP within 15 years. The annual minimum payment is about 1/15 of the withdrawn amount, so about 4% a year of what you withdrew, you must pay back. Failure to repay these amounts is going to add to your taxable income of the amount that you missed. So if you missed your payments over the 15 years, so you don't repay any of it, at 15 years, you're going to have an additional 60,000 of taxable income. Now, the next vehicle that we can use to buy our first home is brand new this year. It's the First Home Savings Account, also known as the FHSA. The FHSA is a bit of a hybrid between the RRSP and the tax-free savings account. Now, it has the benefits of the RRSP because when you invest in the FHSA, it's a tax deduction, so it's going to lower your taxable income, which is a great benefit. And it's got the other half of the TFSA of the hybrid I'm talking about is that qualifying withdrawals are tax-free. So you're not going to be having to pay any taxes on this, and you don't need to repay it within 15 years. Once you use it for a qualifying purchase, buying a home, you don't need to repay it like the home buyer's plan within the RSPs. So some key information for the First Home Savings Account is that you can only contribute up to $8,000 per year with a lifetime limit of $40,000. Now, if you max 8,000 for 5 years, you're at 40,000. The account can only be open for 15 years. So if you're thinking, I might make a lot of money in the next 5 years, so I'll be able to save up and then I'll just dump all this money into the FHSA, that won't work because the maximum carryover is 16,000 or 2 years. So if you open it up today, 2024, and you don't invest in 2024, you don't invest in 2025, and then you want to invest in 2026, you'll still only have 16,000 rather than the 24 because it only carries over to 16. Now, withdrawal rules has to be a qualifying purchase, and that's the only way you can take it tax-free. Now, let's say you don't use the FHSA within the 15 years and you have the 40,000 lifetime limit. What happens to it? It doesn't just disappear and you don't take it as income. It just rolls over to your RRSP and it doesn't affect any contribution room. So if you were at your max of your RRSP, you just get an additional 40,000. You're not going to be having any overages. So the FHSA max contribution room, we're just assuming that within the first 5 years, you did the 40,000. It could look anywhere between 40,999 if you only made 1%, all the way up to 48,000. So with compounding growth of starting early and investing early, you're going to have more purchasing power at the end. Now, in the full 15-year growth, we're assuming that you didn't really make much in the first 5 years. So you're at 40,000, barely 42 plus. But through 15 more years, you'd be looking at anywhere between 69 to 96,000, even more, depending on the funds you're invested in to buy your first house. Now, we couple that with the home buyer's plan, you could have up to 100, 120, 160, 200,000 of contribution of available money to purchase your first home. Within the home purchasing power, we're going to go through each account here. So the RSP room, we're assuming that we make 100,000 and each year we have 18,000. So that's our RSP room, and that's how much we're going to deposit. FHSA is stuck to 8,000. We're assuming that we're going to be doing the full FHSA every year, and we're assuming the TFSA contribution rooms don't change year to year. They often do, but in this example, we're just making the assumption they don't. Every year, we're going to get a tax refund about $5,400. So we saw that in the previous slide, a couple slides ago, and then a tax refund from the FHSA, you're going to total refund of $7,800. Now, if we use the $60,000 from the RRSP home buyer's plan, the FHSA, and then we use the TFSA, and we reinvest the tax return, say, into a non-registered account, which is an account we'll go over, you'll have a total of $192,000 for your one individual to buy your first home. And then just the FHSA and the home buyer's plan, you'll have up to 106. So we could be looking at, if you and your partner were looking to buy a house, we could be looking at 212,000 to buy your first house. Now, the tax-free savings account is a really advantageous account to use here in Canada. The contributions are made after the tax dollars, so that means that you get paid on, you get taxed on your income, and then you put this into the TFSA. The growth and withdrawals aren't taxed. Each year, you're allowed to have the next amount. So this year was 7,000. They're going to change it. Last year was 6,500. You can use up that amount. You can only start investing at 18. Now, the maximum contribution limit is 95,000. The really great thing about the TFSA is, let's say I use the TFSA room up. I'm at 95,000 and I use the 7,000 this year, but then I have to withdraw it. That doesn't mean I lost that contribution room forever. So 2024, I withdraw that 7,000. The next calendar year, 2025, that contribution room gets re-added to my available contribution room plus the next year. So if we're assuming this year's 7,000, next year's 7,000, and I withdraw 7,000, I'd have 14,000 to invest next year. The ideal uses for the TFSA can be short-term, emergency funds, and long-term. It's really ideal. If you're retirement planning, this is a great investment vehicle because you're going to be taking income tax-free. Emergency funds are great, and short-term because you can take it tax-free. Now, if you're 18, back in 2009, all the way up to now, you'd have 95,000 contribution room. This just shows it's indexed to inflation. It increases every year. 2015 was a bit of an outlier, but it's gone up about 500. They round it to the nearest 500. Now, non-registered accounts. These are accounts that don't offer the same tax advantages as registered accounts. So you're not going to deduct any taxable income with them, but they provide a little bit more flexibility because there's no limits to how much you can invest. So if you max out your RRSP and your TFSA and your FHSA and you still have money that you want to invest, a non-registered account is a great option to do so because there's no limits. Now, there are tax implications to these accounts. Earnings from these non-registered accounts, interest, dividends, capital gains will be subject to taxation. Capital gains will carry over indefinitely. If you suffer a capital loss, you can have 2-year carryover. So if you're going to do some investment strategies to try to minimize your tax burden, you can have an advisor at least know that you have 2 years to leverage your capital losses. Now, going through portfolios and how to invest and what to invest in, some of the best approach is to have a balanced portfolio so you don't have all the eggs in one basket, as people like to say. The balanced portfolio approach involves equities, which are stocks, used for long-term growth, can be used for short-term growth. Bonds, which are fixed income, you're going to have stability with this. They're going to offer you a yield to maturity rate, cash, and GIC. So these are typically low risk investments because they offer guaranteed amount of money, and you mix them together within these funds, you're going to have 60-40%, so 60 equity, 40% fixed income, and these funds are actively managed, so there's a 10% leeway within these funds. So if fixed income drops, we're sitting at 70-30, they're going to buy equity at a profit, buy fixed income cheaper, and balance it back out, and vice versa. So that's why it can be quite beneficial, because we can kind of get the best of both worlds. Investing long-term is important because we want to look for diversification, and we really want to have patience and discipline because it's all about time and market. So being well diversified, balanced portfolio, not having all your eggs in one basket, as I like to say, is really important, and staying patient and disciplined with your investing because it's a habit, and patient because the market will go up and down. Now, a really good example of why time and market is important is compounding growth. And that's what's really spoken about when talking about investing. So within this example, we're looking at current portfolio. Let's say you're just getting started. It's at $10,000 and you have a monthly contribution of $500. Say you're 20 years old. In 35 years, will be 55. With only $220,000 worth of contributions, your money would bare minimum turn into $625,000, because 5% is the minimum we look for, to maximum 1.3 million up. Right? So it's all about having that time and market, because that's not a whole lot to invest, but that's a whole lot to have in retirement. And dollar cost averaging, it's really important to invest and to have a habit of investing, and the best way to do that is monthly. And doing it monthly will allow you to save money and buy these units at a cheaper price. So we're assuming we're at 8,000, lump sum at $10. After several months, it goes back up, down at $10. Your return is 0. But if you invest monthly at 1,000 for 8 months, you have a 4.07 because you're buying at different times in the market. So it's really important to build the habit monthly because it's better for you and it's better to have that habit. This is a comparison of what we just spoke about. And if you want to take a look at it a little bit more, you can check out the Instagram. It's got a lot of good stuff like that. But that is all I have for today.